Okay, good morning and welcome to today's meeting of the SEC's Small Business Capital Formation Advisory Committee. I to order. First, I want to extend a warm welcome to everyone, including those members joining us remotely today. It's great to see you all. We also really appreciate members of the public who have tuned in to watch the meeting via webcast on sec.gov. Courtney, do we have a quorum for today's meeting?
We do have a quorum, and also I'll take this opportunity to say for any staff that speaks today, any views we provide are in the speaker's official capacity at the SEC, but do not necessarily reflect the views of the Commission, the Commissioners, or other members of the staff. Thank you.
Thank you, Courtney. All right. Well, we want to apologize to everyone for the technical difficulties. We'll hopefully have them worked out quickly, but we will proceed while we work those out. So, at our last two meetings, we discussed the accredited investor definition in depth and proposed ways the definition could be improved with a view towards positively impacting the capital raising process for both entrepreneurs and investors. We're pleased to report that the committee finalized and delivered those recommendations on the accredited investor definition to the Commission. Today, we will continue exploring ways to expand access to and streamline the process of early-stage capital raising. This morning, we will discuss regulation crowdfunding, also known as Reg CF, a pathway that has gained popularity and attention in recent years, though it still accounts for only a small fraction of total capital raised. Crowdfunding offerings have become an important source of funding for underrepresented founders and geographically diverse companies, so we look forward to the committee's discussion on this topic. Today, we aim to better understand just how Reg CF is being used and with what level of success, what types of founders and investors are using Reg CF, and to identify any unnecessary points of friction in an effort to determine how to improve the exemption's effectiveness as a capital raising tool. This afternoon, we will explore the state of angel investing, tapping into the wealth of experience from our committee members around this table, both physically and virtually. Angel investing is vital to many small businesses around the country, and the data shows that there are many investors who are still very interested in the asset class. We'll discuss current market trends and whether there are ways we can help improve the flow of capital to early-stage founders who need it. But before we get started, we are so pleased to have Chair Gensler and the commissioners join us. We appreciate you all being here, and until we are able to get Chair Gensler on Zoom, I'd love to start with remarks from Commissioner Peirce, who is here with us in person. Thank you.
Thank you, Erica, and thank you all for your continued willingness to serve. I look forward to today's discussions on crowdfunding and angel investing, both of which are invaluable to capital formation at early stage companies. I also look forward to hearing your discussion with Val, who is the head of our Strategic Hub for Innovation and Financial Technology. A recent conversation, one of many conversations over the past 6 years, reminded me of just how important and appropriately empowered FinHub could be for small businesses. The story always runs something like the following. An entrepreneur who has built a small company with promising commercial prospects would like to introduce a crypto token. This entrepreneur has had numerous conversations with lawyers, but he'd like to get confirmation that his company what his company wants to do can be done in a manner that's consistent with the securities laws. With whom should that entrepreneur speak? I'd like to be able to tell him to approach FinHub to discuss the possibility of a no-action letter or exemptive relief to provide the necessary legal comfort to move forward. For that to be feasible, though, the SEC has to empower FinHub to grant such relief after consulting the appropriate people across the SEC. And they have to be able to do that on a timeline that's consistent with commercial urgency, which is always an issue for small companies that are on, that have limited funding. The SEC as a whole, however, is showing a reluctance to work productively with the public through difficult legal, regulatory, economic, and accounting questions. FinHub can't be a one-way door into a building that only views crypto through an enforcement lens. FinHub has a knowledgeable, energetic, and highly engaged staff, but that staff needs the institutional backing to work with startups to facilitate commercially viable and legally compliant innovation. I therefore urge the committee in your discussion with Val this afternoon to discuss how FinHub can be empowered to foster an environment of collaborative experimentation with new technologies. I welcome the committee's discussion of crowdfunding, including how to improve its regulatory framework. As law professor Andrew Schwartz explains, crowdfunding can provide early-stage companies with a, quote, simple and inexpensive method of raising capital to help all stripes of entrepreneurs access capital and allow ordinary people to make investments that have traditionally been limited to the wealthy and connected. I have some questions for the committee on this topic. Specifically, during the COVID-19 pandemic, the Commission temporarily raised the threshold governing reviewed financials from $107,000 to $250,000. That relief lapsed in 2022, and the current threshold is $124,000. Should the Commission raise that threshold to somewhere between $250,000 and $500,000? Second, would the crowdfunding market improve if state blue sky laws were preempted for secondary market transactions in crowdfunded securities? And third, should the Commission make it easier for crowdfunding portals to provide impersonal investment advice so that portals could provide some basic curation? I also am looking forward to this afternoon's discussion on angel investing, including how to encourage it. Angel investors provide early-stage companies not only with capital, but also with mentorship grounded in years of accumulated business wisdom. This mentorship works best in communities that are crowded with angel investors, so early-stage companies can learn from a wide range of successful business leaders. Angel investing is often a team sport. Angel investors not only invest together, but they learn together. More seasoned angels educate the newer angels. Because angel investors must be accredited, the committee's recent recommendations on the definition of accredited investor are particularly relevant to today's discussion. Our restrictive accredited investor standard disqualifies 82% of Americans from accessing private investments, including through angel investing. Given cost of living based income disparities, it's harder for angel investing to flourish in small, inexpensive cities than in larger, expensive ones. By one estimate, for example, a woman making $250,000 in New York City needs only $96,000 annually in Cleveland to maintain the same standard of living. The lower cost of living in Cleveland means that her dollars go much further, but existing accredited investor thresholds do not recognize that fact. The committee made two recommendations that could mitigate the arbitrariness of the definition. First, the committee recommended that the Commission not adjust the financial thresholds even prospectively for inflation. As committee members know, inflation adjustments would empty the angel ranks in cities that need them most. Not raising them will keep angel groups intact and allow them to invite more members of communities to participate over time. Second, the committee recommended allowing individuals who successfully complete an educational program to invest up to 5% in total of the greater of their income or net worth over a 12-month rolling period. If this recommendation were adopted, our New York transplant, now relishing life in Cleveland, although only making $100,000, could invest almost $5,000 as an accredited investor. She would no longer be prohibited from being an angel simply because she prefers to live in Cleveland. I would love seeing a fuller unlock by allowing education to unlock full accountability, eligibility without that cap. In your angel investing discussion today, you might want to consider whether the low percentage cap will still exclude most investors below the current income and wealth thresholds from participating in many private investment opportunities. Mandatory investment minimums might be higher than the permitted investment amounts. The committee's third recommendation, which calls for new Reg D disclosures about key investment risks, could be useful if it's a simple beware new small companies equal big risks type of disclosure, but we have to be careful. Last year alone, issuers relied on Reg D to raise around $3 trillion, including from many angel investors. Beyond a basic buyer beware type disclosure requirement, mandatory disclosures could undermine the freedom to craft disclosure in response to demands by investors as opposed to regulatory demands. Thank you for your consideration, and I look forward to your discussions.
Thank you so much, Commissioner. Really appreciate that. Wonderful. Chair Gensler, are you able to hear us now?
Yes, very well. I was able to hear Commissioner Peirce's discussion of angels in Ohio.
Wonderful. Thank you so much. And now that our technical difficulties have been resolved, it's my honor to invite you for remarks.
Thanks so much. And I'm pleased to speak to the Small Business Capital Formation Advisory Committee. As is customary, and I'm sure my colleagues said, I'd like to note that my views are my own. In my case, as chair of the SEC, and I'm not speaking on behalf of my fellow commissioners or the staff, or I assure you, Commissioner Peirce, there are many people and others that could be angels in any state of this country. I understand the committee will discuss alternative methods of capital raising in our markets, particularly crowdfunding and angel investing. And the committee will hear about crowdfunding from Dr. Melody Chang, Assistant Professor of USC, Marshall School of Business. Small and early stage businesses often start out raising money from friends and family, but that, of course, if you have success, that gets tapped out pretty quickly. And often means eventually outstripping the friends and family's available capital, sometimes very quickly. And that's why alternative methods of capital raising play such an important, critical role to business formation. Angel investing, crowdfunding have helped develop our vibrant private markets alongside robust public markets. And I believe our U.S. economy, as well as individual companies and entrepreneurs with ideas, have and will continue to benefit from capital formation in both the private markets, such as crowdfunding and angel investing, and the public markets. When it comes to the public markets, Congress has required companies to register public offerings of securities with the SEC and include specified disclosures to investors. At the heart of those disclosures lies a basic bargain embedded in our securities laws. And this has been true for 90 years. It's that investors get to decide on their investments, but it's based upon full, fair, and truthful information material to their investment decisions. Meanwhile, Congress, all the way from the beginning, and the Commission have also created certain exemptions from those requirements, including smaller businesses with smaller pools of investors. And these exemptions have formed part of the private markets as we know them today. So they coexist. Private, public, congressional exemptions, commission exemptions live in that balancing. Congress and the SEC have repeatedly revisited these various exemptions over time with a careful eye towards protecting investors on the one hand, facilitating capital formation on the other. For example, in something known as the Jobs Act, Title III of this 2012 law, Congress expanded the exemptions to include crowdfunding, and then the SEC then adopted Regulation Crowdfunding. I think you'll hear from Commissioner Uyeda, who subsequently was in a chair's office working on that rule, and you'll hear more about it today. When Regulation Crowdfunding first went into effect, I think adopted in 15 but went into effect in 16, we saw 22 new crowdfunding offerings per month on average. Firms were allowed to raise at the time a maximum of $1 million under that exemption. By 22, 6 years later, we saw the average go up about sixfold to 135 offerings per month. The funding cap had also been risen to about 5 million annually, and the number of U.S. counties with crowdfunding companies more than doubled between 2019 and 2022. The trends are part of the SEC's ongoing work on behalf of the businesses that seek to capitalize on opportunities and investors to participate in them. Separately, I understand that Val Supenik, who leads the SEC's strategic hub for innovation and financial technology, more commonly called FinHub, will share some thoughts on the landscape concerning crypto assets and crypto token offerings. As I've said in the past, the Commission acts within the law and how the courts interpret the law without prejudging any specific crypto asset. I believe that the vast majority of crypto assets are investment contracts and thus subject to the federal securities laws. Full, fair, and truthful disclosure are at the heart of those laws. It underlies that basic bargain that I discussed earlier. And there's nothing about the crypto securities markets that suggests that investors are less deserving or in need of those disclosures or the protections of our securities law. To investors who may be listening to this webcast, without prejudging any specific crypto asset, absent such mandated disclosures, these are mandated in our laws to help investors make their investment decisions. Absent that, I encourage investors to exercise caution about the myriad risk associated with products whose value is tied to crypto securities. I look forward to the committee's thoughts on all of these matters. I thank you, and back over to you.
Thank you, Chair Gensler. We appreciate your remarks. And with that, I'd like to invite Commissioner Uyeda.
Well, thank you very much, Erica. Good morning. It's a pleasure to be with all of you virtually, at least, at the committee's May meeting. In 1992, Congress enacted a law designating the month of May as Asian Pacific American Heritage Month. Thus, today's agenda for the committee is particularly appropriate, given the deep connection between the Asian American and Pacific Islander community and small businesses. According to the U.S. Small Business Administration, there were nearly 3 million AAPI-owned businesses in 2019. These businesses employed around 5 million people and generated nearly $990 billion in sales. First-generation immigrants, like those in the Asian American Pacific Islander community, often find limited opportunities for meaningful employment, yet they may have significant entrepreneurial spirit. And I've personal experience working in such a business. My first job as a teenager was working for my grandfather's family business in Southern California. Driving a small truck, he would deliver produce to restaurants and retailers from the wholesale market. Through persistence and hard work, he accomplished the American dream. The story of the immigrant family business has been repeated countless times and become an important cornerstone in the Asian American and Pacific Islander community. The struggle of such entrepreneurs have played a role in shaping my views on the regulatory environment for startup capital. Today, the committee will discuss two topics within startup capital: regulation crowdfunding and angel investors. As directed by the Jobs Act, the Commission adopted Regulation CF in October 2015. As a member of the Commission staff, I worked on both the proposal and final adoption of Regulation CF. Jenny Riegel, Amy Reichhauser, and Julie Davis, all of whom work very closely today with this committee, also worked on the adoption of that regulation. Nearly 9 years later, we can evaluate whether crowdfunding has achieved its intended goal of providing startups and small businesses with capital by making relatively low-dollar offerings of securities less costly. According to the latest annual report from the Office of the Advocate for Small Business Capital Formation, regulation crowdfunding has been particularly attractive to small businesses located outside of traditional capital hubs. Professor Melody Chang, who will be the speaker for the Regulation CF session, suggests that there may be, quote, a potential lack of awareness among women and minority-led startups about the opportunities presented by regulation crowdfunding. I look forward to hearing a readout of the committee's discussion of regulation crowdfunding, opportunities and challenges as a method of early-stage capital raising. The second topic will be angel investing. I recently had the pleasure of visiting a startup company in Miami and met with the founder and her angel investors. They emphasized the gap in available capital for small companies that have outgrown what can be raised from friends and family, but are below the investment size of a venture capital fund. The startup nature of the business often means that bank financing is also not an option. While angel investing is not for everyone, I'm interested in further learning the extent to which angel investing can play a role in facilitating capital formation. Finally, I would like to congratulate this committee for issuing its recommendation on the accredited investor definition last week. These were the first official recommendations since the commission was largely reconstituted last June. I look forward to further recommendations from this committee. So thank you very much for your time and participation today. I hope you have a very productive meeting.
Thank you so much, Commissioner. We appreciate those thoughtful remarks. And thank you to the chair and on both commissioners for making some time for us this morning. All right, with that, we are pleased to jump into our first topic of the day, regulation crowdfunding. Reg CF enables companies to raise capital from their local community, product loyalists, and other non-accredited investors. Reg CF offerings allow eligible companies to raise up to $5 million in capital in a 12-month period from investors online using a registered funding portal or a broker-dealer. An interesting statistic in the SEC's amazing Small Business Advocacy Team's annual report is that 70% of capital raised through Reg CF is distributed outside of the top 10 capital hubs, and approximately 25% of crowdfunding offerings in Q3 2022 had at least one founder of color. So this really is a pathway that is increasing access to capital for many small businesses and underrepresented founders across the U.S. We thought we might begin by having SEC staff provide some background information on Reg CF to the committee and audience, recognizing that whilst most of us are familiar with crowdfunding, we don't all have specific understanding of the regulatory framework. And for that, I'm going to turn it over to our fellow committee member and the SEC Small Business Advocate, Stacey Bowers. Stacey?
Thank you, Erica, and good morning, everyone. So I'm just going to provide a little bit of a high-level background of some of the regulations that govern crowdfunding to sort of set the stage before Dr. Chang provides her presentation and all of you head into the discussion. So just as a reminder, I think everyone in the room recognizes whenever you offer and sell securities, they either need to be registered or there has to be an exemption from the registration requirements, and regulation crowdfunding is one of those exemptions. So it was created by Congress under the Jobs Act of 2012 and with a fair amount of specificity about the rules that went into effect in 2016. So just to highlight, I'm only going to highlight a handful, I couldn't cover them all, but to think about the aggregate offering amount. So while Reg CF initially allowed $1 million, it has since been adjusted twice, once for inflation, and then most recently as part of the SEC's harmonization initiative. And so now during a 12-month period, as Erica mentioned, an issuer can raise $5 million under a regulation crowdfunding offering. One thing to note about crowdfunding, which makes it a little bit different than some of the other exemptions, is every crowdfund has to happen through a registered intermediary. And that can be either a broker-dealer or a funding portal. And the crowdfund has to occur online as well. So sort of the idea being the crowd will fund the offering and that will happen through this online portal. And then I do just want to highlight that an issuer can only use one portal at a time. So they can't list their crowdfund on with multiple intermediaries or multiple portals at the same time. So both accredited and non-accredited investors can invest in a Reg crowdfund offering. And while originally there were limits across all investors and the amount of money that they could invest, those also shifted in 2020 as part of harmonization. So now accredited investors can invest an unlimited amount of money into a regulation crowdfund. And we rely on that same definition that shows up in Reg D to define what is an accredited investor. And then non-accredited investors, their dollar thresholds have also been adjusted, but there are limits on the amount of money that a non-accredited investor can invest. I'm gonna try and do this and make it make sense because I always feel like it's a little bit of a tongue twister. So if a non-accredited investor has annual income or net worth of less than 124,000, they can invest the greater of 2,500 or 5% of the greater of their annual income or net worth. If an investor has annual income or net worth that exceeds 124,000, then they can invest 10% of the greater of their annual income or net worth. So hopefully I got to just give you a sense of how that plays out, and I'm sure George will be able to weigh in a little bit more clearly as somebody who runs one of the portals and has to make those assessments. So one of the things that happens with a Reg CF offering is the issuer has to file a Form C. And this is a disclosure document that puts information out there to potential investors about the Reg CF offering. And so I'm just going to highlight a couple of the disclosure items that show up in the Form C. So offering amounts. So with every Reg CF, there has to be a targeted amount, and the issuer has to meet that target by the target deadline in order to close their regulation crowdfunding. So that target amount and that target deadline will be included in the Form C. And then the issuer might also be willing to take more than the target, and if they're going to take a maximum, that has to be indicated as well. In addition to that, how they will accept that sort of oversubscription of funds. You're going to get some information about the company itself, about its business, its employees, its holdings, those type of things. There'll be some risk factors. There'll be disclosures about the directors and the officers of the company, about the beneficial owners, so those investors who already own greater than 20%. The company will have to explain how it's going to use the proceeds from the Reg CF offering. They have to describe their capitalization structure. So they have to talk about the various classes of securities that they have created that are also outstanding and the terms around those. And they also have to provide disclosures if maybe they've issued promissory notes previously, so they're going to provide that information as well. Another thing that the Form C has to cover is the cancellation process. So one of the things that happens in a Reg CF is that an investor has up to 48 hours prior to when the offering is set to close to change their mind and cancel their subscription. So that cancellation process has to be set out in the Form C. And then the other thing that happens with a crowd fund is if there's been a material change in the terms, investors have to reconfirm their commitment to participate in that crowdfunding and remain in it as an investor. So that information will be set out. So that's just a little bit of a highlight of what's required in the Form C. By no means does it cover every piece of disclosure that's required. I do want to touch a little bit just on the financial statement requirements because I think it could play a role in your discussion today. So if an issuer is raising $124,000 or less, in that circumstance, they need to include the same kind of financial information that would be in their federal tax return. And that has to be certified by a principal executive officer of the issuer. If the issuer wants to raise more than $124,000, but not more than $618,000, then the financial statements have to be reviewed by an independent public accountant. Though I will say, if that issuer has audited financial statements, then they do have to provide the audited financial statements. And then if an issuer is raising greater than $618,000, they have to provide audited financial statements. There is an exception if it's the first time that they're doing a crowd fund and they're not raising more than $1.235 million, then they can provide audited, or not audited, but reviewed financial statements. So there is a little bit of an exception for that first time issuer doing a crowd fund in that circumstance. But again, just like with the prior discussion, if they happen to have audited financial statements, then they do have to provide those. The other thing to just highlight a little bit is that issuers, they do have some ongoing reporting requirements as a company that's done a crowd fund. So they have to file an annual report, and they have to file that within 120 days of their fiscal year end. And similar to the Form C, they're going to provide certified financial statements unless they have reviewed or audited financial statements to provide. And then the annual report requirement, it goes on for a certain amount of time, but there are different ways that that can come to an end. So if the issuer has filed at least one annual report and now has less than 300 holders of record, they don't have to continue to file an annual report. Also, if they filed 3 annual reports and they now have less than 10 million in assets, that obligation to file the annual report. And then also if the issuer becomes a 34 Act reporting company, so they're filing their 10K and 10Qs, then they don't have to do the annual report for Form C. And there are some other ways that that obligation goes away, but just to highlight, that requirement can change depending on the issuer and its situation. There are some other filings that happen for issuers who are doing a Reg C. So as I mentioned, they have to file the Form C before they start their offering. If they amend that Form C, they have to file a Form C/A, just indicating there's an amendment. They also have to provide what is called Form CU, which is a progress update. So that's letting the investors know where they are as far as hitting 50% of their target, and then also at the point that they hit 100% of their target. We talked a little bit about they file an annual report, which is the Form CR. And then when they no longer have to do the annual report, they file a form, I'm going to look down at my notes, TR, the terminating report, indicating they're no longer required to file that annual report. So advertising. So there are requirements about advertising a Reg CF offering, and issuers cannot directly or indirectly advertise the terms of the offering. With that said, they can have a small statement that they put on their website that indicates that they're doing a CF offering. They can highlight a few of the factual terms and then provide a link to the intermediary, generally the portal that's hosting that Reg CF offering for them. On the other hand, they can communicate through the portal. So one of the things that intermediaries are required to do is to provide communication channels. So within those communication channels, investors can communicate with each other. So again, back to the idea of the underlying idea for crowdfunding, for investors to be able to communicate with each other. But also within that communication portal, the issuer can communicate and answer questions that are posted, provided that they make it clear that they are the issuer or they're a person acting on behalf of the issuer. Also in a crowdfund, the issuer can pay a promoter to help promote, and if the promoter's in there on that communication channel, they also have to make it clear that they're acting as a promoter and they're being paid promoter compensation. One of the things that also changed in 2020 is the ability for the issuer to test the waters, so to speak. So to take that opportunity to see, is it worth undertaking a crowdfund? Knowing that any of those communications that they put out to test the waters are considered to be an offer of securities, and so would be subject to the anti-fraud provisions. Intermediaries have their own set of regulations that govern them and that they have to fill in being an intermediary. So they have to be registered. They have to believe that the issuer complies with the crowdfunding requirements before listing them on their portal. They have an obligation to provide educational materials to potential investors. As I mentioned, they have to create these communication channels. They have to have processes in place for investors to be able to open up accounts and to fill out the paperwork that will indicate whether they're an accredited or a non-accredited investor, so that there's an understanding about those investment limits. And that barely touches the surface, I think that's fair to say, George, of all the things that intermediaries have to do. And then I just want to highlight a couple of miscellaneous points when it comes to Reg CF. So the securities are restricted. So that means the securities can't be readily resold for the first year. With that said, they can be sold or transferred back to the issuer, to another accredited investor, or to a family member, or they can, if it's part of a registered offering. The securities are exempt from the state blue sky laws, obviously not the anti-fraud provisions, but the state blue sky laws themselves. And then there are no limits on the number of investors in a regulation crowdfund, and there are no limits, sort of as we see with Reg D, there's not a limit to how many can be non-accredited versus accredited. that's just a little bit of a high level of some of the regulations. So as you start your discussion after Dr. Chang's presentation, to just give you some background. Thanks.
Thank you so much. Really appreciate that overview. It's incredibly helpful. So, with that content and background, I'm very happy to introduce our invited speaker, Dr. Melody Chang. Dr. Chang is the Assistant Professor of Management and Organization at USC's Marshall School of Business. Her research is in the areas of entrepreneurship, labor markets, and innovation, with a focus on how entrepreneurs and innovators from diverse backgrounds and experiences can successfully navigate the labor market and capital markets. Dr. Chang holds a PhD, Master of Philosophy, and a Master's in Management from Yale University, as well as a BA in Economics from the University of Pennsylvania. Prior to her doctoral studies, she was an investment banking associate at Goldman Sachs. We invited Dr. Chang to be here today because she is the author of a just-released independent academic report, Women and Minority-Owned Businesses in Regulation Crowdfunding, on the experiences and outcomes of women and racial minority business owners who participated in Reg CF. Dr. Chang, welcome.
Hi, thank you so much for the introduction. Let me share my screen. Can everyone see my screen?
Yes.
So thank you so much again for inviting me to this meeting. I'm really excited to be part of this discussion. So Stacy provided a wonderful overview of Reg CF and the legal requirement, and I'll extend the discussion by focusing on women and minority entrepreneurs in Reg CF. Specifically, I'll be examining their participation in outcomes in Reg CF, as well as their business performance before and after the participation. So this is as Commissioner said, this is a timely investigation as Reg CF will have its 8th anniversary soon. And the key feature of regulation crowdfunding compared to other traditional funding sources is that it allows startups and small businesses to raise capital from the general public, including non-accredited investors. And historically, startup investing was only open to accredited investors like venture capitalists and angel investors who are predominantly white male. And because investment decisions are driven by social networks and people prefer to make investments to those who share similar social characteristics, there have been funding disparities based on gender and race. So we know that only less than 1% of new businesses in the US receive investment from VCs, and just 2% of this capital went to all female founders, and only 1% to Black founders. And this is a huge problem because often women and minority entrepreneurs lack resources to kind of sustain and build their businesses. And while solving financial disparities was not the primary goal of this funding source, many people believe it could reduce barriers to capital access, especially for women and racial minority entrepreneurs. And this is because startup investing became available to a broader, more diverse investor base with the introduction of crowd. So the goal of my research is to address whether women and minority business owners can benefit from Reg CF, what are their experiences and challenges so far. So today I'll start off with a brief overview of Reg CF landscape. Then I'll discuss participation of women and minority-owned businesses, as participation is the first step in assessing the effectiveness of the funding program. Third, I'll observe the Reg CF outcomes of women and minority-owned businesses. And then I assess what happens after Reg CF funding rounds, such as future funding and exits. And I'll consider how these outcomes vary based on gender and racial ethnic groups. And finally, I will end with some policy recommendations and open up the discussion to the public. So starting with a brief overview of Reg CF, during this study period, which is from its inception in May 2016 to the end of 2022, there were nearly 6,000 offerings by 5,200 businesses that collectively raised $1.4 billion in total. And you'll notice that the landscape of Reg CF has experienced a remarkable transformation The number of offerings and amount raised are on upward trajectories. Especially, you can see that during the COVID era, there has been a huge uptick in the participation. And RexCF has attracted entrepreneurs across broad industries, from local businesses to high-tech startups. So they are Main Street businesses like food, beverage, and restaurants that contribute to local communities and economies. We also see a lot of innovation-driven companies like software applications, consumer products and goods, which include hardware and innovative consumer products, which are also popular. So there's a diverse set of businesses and products that are participating. And most firms that seek funding through RexCF are relatively young, with nearly half being 2 to 3 years old. Around 70% are less than 3 years old. And in terms of business size, small firms with 2 to 3 employees constitute the largest group. Around 90% of companies have less than 10 employees. So you can see that the RexCF is targeting very young and small companies. So my report contains more details about business and financial information about these firms. So if you're interested, please check it out if you want to learn more about these firms. So who participate in RexCF, and are we seeing a lot of women and minority-owned businesses? And I classified each business into 3 gender composition groups. So first, all male, all female, and mixed gender teams. And you can see that the majority of all founding teams consist of all male founding teams. But on a brighter note, the proportion of all female teams has increased from 10% in 2016 to 14% in 2022. Right? So although there is still underrepresentation in terms of gender, there has been some improvement being made in terms of composition. In terms of race and ethnicity, I first categorize each firm into 3 categories. So all white teams, all non-white, which includes Black, Hispanic, Latino, and Asian entrepreneurs, and also mixed non-white and white. And 71% of businesses are led by all white founding teams, 21% are led by minority only. And I tried another grouping method by distinguishing Black and Hispanic Latino founders who are particularly underrepresented in the startup resource landscape. The proportion of all white teams remained the same, but here I separated out the all Black or all Hispanic Latino, which represent 11% of the businesses. Also, Black or Hispanic on team represent 4% of the businesses. Other racial ethnic mix represent 13%, and this includes Asian-led or mix of Asian white entrepreneurs. So similar to gender composition, there has been some improvement being made. The proportion of all white in green decreased, and while the proportion of all non-white teams have increased twofold from 11% in 2016 to 23% in 2022. And if we distinguish Black and Hispanic Latino founders, we see more and more Black and Hispanic founders over time, as shown in the navy and gray bars. So overall, there is still underrepresentation in terms of gender and race, but there have been some improvement over time. And I explored pre-offering performance differences, which are indicative of the quality of the business. And I look at the proportion of businesses that generated revenue and profit prior to participating in RexCF. And I find that all female teams have higher proportion of businesses that generate revenue and profit, followed by mixed gender teams. And it is noteworthy that the female-led teams actually tend to have better financial performance than all-male teams going into RexCF. And in terms of racial ethnic composition, all white teams have the highest proportion of businesses generating revenue, although the difference between the groups are pretty small. But I find that minority-led teams, in particular, all Black or all Hispanic Latino teams, have the highest proportion of businesses generating profit of 18%. And while prior research suggested that investors often undervalue the competence of female entrepreneurs and racial minority entrepreneurs, the objective performance data of these early-stage businesses show that these assumptions are unfounded, and in fact, women and minorities often have better track records than those of male-led or white-led teams. So just to summarize what we saw in terms of participation, the proportion of women and racial minorities are still underrepresented, but increasing over time. Participative firms led by women and minorities had track records that often surpassed those of male-led and white-led teams. And the participation analysis highlights that entrepreneurs from historically marginalized groups need to be more aware of this relatively new funding source. Also, it is imperative to make sure that this funding source is accessible to women and minority founders because these business owners are often resource constrained. So there needs to be minimized costs associated with fundraising. So now let's look at RegCF outcomes of women and minority-led businesses. How do they perform compared to white and male-led business owners? So this figure shows per proportion of businesses that get funded by successfully meeting their target offering amount. Over the years, all groups have seen improved chances of securing any funding. The percentage of all female founders that were funded increased from 59% in 2016 to 77% in 2022. All male teams, their rate climbed from 45% to 81%. So except for the inaugural year, all female founding teams had lower average success rates compared to all male or mixed gender teams. And here I show average funding amount by gender composition groups. All female founding teams in navy bars had the lowest average funding amount across all years. And the average funding amount is around 1.5 to 2 times greater for all male founding teams across all years. So overall, there is no discernible evidence of narrowing the gender gap. And while earlier we saw that all female teams had better pre-offering financial performance, all female teams have consistently experienced lower success rates in receiving funding and tend to receive smaller amounts compared to all male or mixed gender counterparts. In terms of race and ethnicity, you can see that there is a stark funding gap between all white founders in the turquoise color and all Black and all Hispanic founders in a navy line. Especially in the early years of RegCF, Black and Hispanic founders had funding rates lower than 50% until 2019. And for all Black and all Hispanic Latino founding teams, the funding amount difference compared to all white founding teams have narrowed between 2017 to 2020, but this gap has widened since 2021. And in 2022, all Black or all Hispanic Latino teams received check sizes less than half of all white teams. And while all Black or all Hispanic Latino had comparable performance in terms of revenue and superior performance in terms of profitability, they consistently had lower average funding rates and received lower funding amounts. Right. So overall, women and minorities appear to have a higher chance of securing funding by participating in RegCF compared to traditional funding sources. More than half of all female, all Black, and all Hispanic Latino founding teams successfully raised money in RegCF, whereas these groups received 2%, 3% of all VC funding respectively. The funding success rates for all female and all non-white teams are still lower, but are becoming more comparable to those of all male or all white teams over time. But among businesses that raise capital, there are still substantial gaps in funding amount between all female versus all male teams, as well as between all non-white versus all white teams. The average funding amount for all male team is 1.5 to 2 times greater than that of all female teams. Similarly, all Black and all Hispanic Latino teams receive disproportionately less funding compared to their all white counterparts. And next, I examine what happens after regulation crowdfunding and how the future outcomes vary by different gender and racial composition groups. And I'll present findings related to future funding and exit outcomes, given the time constraint. But in the report, you can see more analysis related to various outcomes, including repeat participation, business and financial performance, and survival rates. And here I look at Regulation D funding outcomes. Regulation D funding is usually a private placements, which involve funding by accredited investors like VCs and angels. So here I show how the proportion of RegCF participants that subsequently raised Reg D funding. So I find that RecCF outcome is positively correlated with future RecD funding rate and amount received. On average, around 10% of RecCF participants subsequently raise RecD funding. If you fail to receive funding from RecCF by not meeting your target amount, then the subsequent funding rate drops down to 3%. But if you succeed and successfully raise capital, the RecD funding rate increases to 12%. And considering gender and race, I find that women and minority-led teams, especially Black and Hispanic founding teams, had lower Reg D funding rates compared to all male and all white teams. And the gender and racial ethnic funding gaps really stand out when we consider amount of funding, or the Reg D amount funding. While RecCF has helped some women and racial minority entrepreneurs get started with their initial funding, moving on to more common types of venture financing like Reg D still show how uneven the opportunities are. Right? So this really underscores the need for more policies to support women and minority entrepreneurs beyond just the RecCF stage. When considering exit outcomes of RecCF participants, since the establishment of RecCF around 8 years ago, there have been 14 IPOs and 71 acquisitions as of March 2024. Since most startup exit takes about 5 to 10 years, it is still early to make assessment, but these instances highlight that RecCF has potential as an investment avenue. So this table lists all IPO offerings known to date. Among 14 firms that went public, all businesses except for one mixed gender team are led by all male founding teams. Also, only 2 are all Asian founding teams, while the remaining are all white. So we haven't encountered any Black or Latino-led firms that went public. There were 71 acquisitions. The precise terms of these acquisitions and the exact proceeds distributed to the investors are often not disclosed. The gender composition of acquired companies mirror the gender composition of RecCF participants. There are some successful acquisitions of women-led RecCF participants. About 17% are all-female teams. In terms of race and ethnicity, 8.5% of all acquisitions, a modest proportion, involved all non-white teams, though no acquisition occurred for all Black or all Hispanic founders. So acquisitions of minority-led teams mostly involved Asian founders. So again, it is premature to fully assess the exit and return outcomes of RecCF offerings, but the data thus far indicates that the majority of IPOs and acquisitions are associated with teams founded by all male or all white individuals, which highlight the need for ongoing support. So in conclusion, this report highlights the ways in which women and racial ethnic minority groups engage with RecCF to secure investment and examine challenges they encounter both during and after participation. Although there has been a bump in the number of women and minorities jumping into RecCF, they still don't reflect the full diversity of US business owners. And this means that not enough minority entrepreneurs know about this newer way to fund their businesses. Also, even though women and minority-led businesses were doing just as well compared to those led by men and white teams before they start using RecCF, there are still persistent differences in funding rates and funding amount based on gender and race. And this is problematic because in the report, I show that RecCF outcomes are correlated with future businesses and financial performance, including Reg D funding and survival rates. And this report points out how crucial it is to support businesses after RecCF. Most companies that pay off for investors at the end so far are usually led by all male or all white teams. So, and it is key to recognize that not paying enough attention to women and minority entrepreneurs who often do really well before RecCF is not just overlooking a social issue, it also means missing out on solid business opportunities because of biases. And it is crucial that capital is allocated to businesses based on how they perform, not based on the background of entrepreneurs. In terms of policy implications, it's key that we encourage more people to take part. So platforms and programs like accelerators can think about pushing outreach to underrepresented entrepreneurs through awareness campaigns. Also, there should be fewer barriers to getting involved in RecCF. Right? For example, the government can look at helping out with a cost-associated fundraising like marketing, legal, and accounting fees. Also, it is imperative to tackle any biases in funding. One way to do this is by sharing the success stories of businesses led by women and minorities. Platforms might want to set up anti-bias training, offer perks to encourage taking these trainings. There could also be incentives like investment credits to subsidize offering led by women or minorities. And we learned that ongoing post-RegCF support is crucial, which means networking and mentorship are super important. So platforms and entrepreneur programs should offer opportunities to network, especially for women and minority founders. And to help with successful exit, it is also beneficial to encourage a partnership that can lead to strategic alliances or acquisitions. So mentorship, networking events that involve not only financial investors, but also strategic investors would also be important. Right, so this marks the end of the presentation. Thank you so much for your interest and for listening to my research insights. Please let me know if you have any thoughts. I just want to highlight that creating a more inclusive and equitable entrepreneurial ecosystem requires concentrated efforts from policymakers, platforms, and all stakeholders in entrepreneurial ecosystem. So please keep your continued interest in this area. Thank you so much.
Thank you, Dr. Chang. We really appreciate the important work that you've done here and you taking the time to share it with us today as well. So thank you so much, and we look forward to digging in deeper to this amazing data. All right. Well, Jasmine?
Do we have time for questions?
Oh, yes, sorry. Thank you for the reminder, Jasmine. Wonderful. And does anyone on the committee have questions for Dr. Chang?
I have a question for Dr. Chang. It was a wonderful presentation, very interesting paper. Thank you. I was wondering if you either have done or have any insight, there may be interviews or case studies into the reasons. I'm sort of curious about kind of the differences between crowdfunding versus angels in maybe getting funding to more diverse founders. And I'm just wondering kind of why. I mean, I can speculate as to why, but I wonder if you have any insights on that front.
Yeah, so based on my quick conversations with like the entrepreneurs who have participated in RegCF, I think the reasons why people choose RegCF is because not just because it's like easier to be exposed to a broader group of investors, but it also provides like a good marketing initiatives. It provides like a fan base, kind of support system for the businesses. Also, another benefit of RegCF compared to Angel or VC is that compared to those traditional financing source, you can create your own deal terms. You can set your valuation amount. Right. So the decision making regarding the deal terms, valuations are kind of driven by entrepreneurs, not based on kind of negotiations. So that's another benefit.
Diego?
Yes. So similar to Jasmine, great presentation. Thank you so much. So just as a way of context, so my name is Diego Mariscal. I lead an accelerator for founders with disabilities. So I really appreciated the recommendation specifically around accelerators and encouraging more support to underrepresented founders. But in that same vein, I'm curious if you looked at, I mean, your paper primarily focuses on women and minority, but I'm curious if you've looked at the intersection between gender and other minority groups, and specifically from where I sit, curious if you looked at any disability-specific data, and how might that impacted your research. And then the second question I had was around, you mentioned a number of recommendations, and I'm wondering if those which I appreciated and agreed with a number of them, but I'm wondering, are those recommendations evidence-based, and can we point to those recommendations sort of having substantive gains in the space. Wondering if you could talk a little bit more about that. Thank you.
Yeah, thank you for these excellent questions. So, in terms of your first question related to whether you look at other dimensions beyond gender and race, so in my other studies, I've considered how RegCF is helping to diversify in terms of people who lack social status, like elite education, industry, and location. But I haven't looked into to disability, but it's of my interest. I'm also interested in like SES and disability. So since you are the expert in this area, I would love to kind of keep the conversation going about how we can examine kind of this disability business owners in RegCF's funding space. I think the primary reason that there is not enough research is because of the lack of data around the disability, the entrepreneurs with disabilities. So I would love to kind of keep my interest going in the space, especially if the data becomes more available and accessible. So definitely let's stay in touch, and I would love to hear about your perspectives. In terms of recommendations, I pointed out some recommendations related to awareness campaigns like anti kind of bias training. There hasn't been much research around these interventions, and this is kind of where my future research is headed. It'll be great to conduct some kind of field experiments or like interviews to kind of see if these interventions are successful, particularly if after like collaborating with funding platforms or accelerator programs. So there hasn't been much research around the effectiveness of interventions, and I would love to see more research and conduct research in this area to see whether these policy recommendations, interventions are effective.
Thank you.
Sue?
Yeah, so my question is around, you mentioned that despite the women and minority-led companies having somewhat better financials, many of them having better financial performance going in, they either are not successful at raising financing under Reg CF, or they get smaller checks. Do you have any data that says what happens to those companies? So they either the ones that weren't successful in their Reg CF, even though they had good financials, what happened to those companies over time? And then the ones that did actually close but had less of a check, how did they do over time? Because I think that really goes into something that we're missing from our financial environment if good companies aren't able to raise that money. So what does your data say about that?
Right, and it's definitely like a missed market opportunity because there are so many successful women and minority-led founding teams out there. So my report kind of has more details about what happens to these businesses, whether they get funded through RegCF and whether they don't get RegCF. And I find that the RegCF success and amount raised are correlated with their future performance. So I briefly showed the Reg D funding outcomes. So firms that successfully had a successful fundraising or more easily get funded through Reg D later on from accredited investors. But those that do not get funded through Reg CF, they actually have like smaller chances of receiving subsequent funding. Also, it's correlated with other business survival, revenue, and net income. So getting setbacks in the early stage funding has like a large implication in terms of their future funding. So it's imperative that there is less biases in the Reg CF funding stage.
Thank you.
Bailey?
Yes, thank you, Dr. Chang. I had two questions for you, and thank you for the presentation. The first is a little bit of a gap for me. I was curious if you could illuminate some information about the number of Reg CF internet platforms that exist today. And of those, I'm curious if your research went into, of those internet platforms, which ones were owned or led by women or Black or brown individuals versus white males. So just seeking to understand, the availability of the intermediary channel and the connections there and affinity for use of those. So I'll start there, and then I have one other separate question.
Yeah, sure. Thanks for that question. So, based on my data, there have been about 101 active RexDF platforms during the study period, and around 40 platforms had at least 10 RexDF offerings. 20 platforms had at least 20 offerings, and it's a pretty and the top three leading RexDF platforms account for about 75% of the market share. So there are some clear kind of leaders in this funding space. I haven't looked into the backgrounds of the founders of these platforms, but based on the top leading platforms, based on my quick search, I think the majority are led by all white male founders. But I would love to kind of dig deeper into this issue about like what backgrounds of the founders of the platforms, how does that affect the funding outcomes of women and minority-led businesses?
Thank you for
And
that.
what's your second question?
So my second question, when looking at some of the outcomes data that you shared around IPOs and M&A outcomes, it led me to think about whether more broadly you may have examined the break of what you might call Main Street businesses from innovation economy businesses, matrixed with whether they were female-owned businesses or black and brown or all-white businesses, if you had done any examination of that. So just would love to understand kind of, one, with the broader pie, the breakdown you see there between Main Street and innovation economy based on gender and race, and then for the successful exit outcomes, if there were any trends as well.
Yeah, good question. So in terms of IPOs, I think the majority are more high-tech startups because you need to get kind of support from retail investors. I feel like more high-tech startups are getting more traction in terms of IPOs. It's mostly software, healthcare startups, based on my understanding. In terms of acquisitions, there have been 70 acquisitions. I haven't looked into the kind of specific breakdown of the businesses, but I think here there is a mix of Main Street businesses and more high-tech startups. I've seen a lot of like food and beverage companies, and also some innovative consumer products. So there's a good mix of Main Street and high-tech startups in the acquisition.
Thank you. And any trends based on race or gender that you noticed in terms of the industries?
I haven't broken down into gender and race, but since like all except for one are all male founding teams in the IPOs.
I just meant the overall pipeline. Okay. Yeah.
Overall, yeah. It's in the report, but you can see that in terms of IPO, I think not like except for one, it's all male. Except for two, it's all white. In terms of M&A, I think about 70% are all male, 80% are all white.
Thank you.
For acquisitions. Yeah.
George?
Hi, Dr. Chang. Thank you for your important work. This is George from Honeycomb Credit. I'm curious, kind of building on that last point there. In your study, you showed that nearly 25% of these offerings are for debt or revenue share, and that seems to be a growing percentage as well. So a successful outcome for a debt or revenue share is not an acquisition or a liquidity event, but rather successful repayment. So I'm curious if you have any data on successful repayment rates and returns profiles to investors through kind of that lens from the ones that are not equity offerings, and if so, any data around gender or racial lines there.
Yeah, excellent point about like the exact proceeds to investors. Unfortunately, the information about returns to investors are not publicly accessible, and I really hope to gain more information about these proceeds to investors. Even for IPOs and M&As, it's like hard to get information about the exact proceeds to investors. So, unfortunately, I don't have enough data to answer that question, but. I think the firms, maybe I'll future conduct surveys involving entrepreneurs to kind of get insights about whether you provided returns to investors. But as of yet, it is hard to get data on that information. And if you have any insights, since you run the platform, please share it with me, and I'd love to discuss about this.
Vincent?
Hi, Dr. Chang, Vincent Cordero. Question, you allude to in the recommendations section incentives. What are your thoughts on that in terms of facilitating more investment into diverse-owned funds, companies?
Yeah, so I think there has been some discussions around the entrepreneurship funding programs about like creating investment credits to subsidize offerings led by women and minorities, also supporting R&D's efforts led by women-led and minority-led business owners. So maybe there could be some incentives, some investment credits or potentially tax credits for a business making investment into those companies.
Herbert?
Good morning, Dr. Chang. Herbert Drayton. Two questions. One is, in your research, were you aware of any sort of platform thesis for any of these crowdfunding platforms that prevented them from allowing folks to put offerings on the platform to cover the gamut from the mainstream business up to the software? And then the second question, were there any noticeable barriers with the application process that prevented minorities and women from applying?
Yeah, so in terms of like platform investment thesis, I feel like the leading platforms are mostly open to all, but they have these like sections highlighting like women founders, Latinx founders, Black founders. So I think there are some sections that are the platform that are kind of showcasing these minority women-led firms. I feel like platforms like Mainvest are kind of targeting more kind of Main Street businesses. So they are some platforms that have focus areas. In terms of your second question about the application process, I feel like the key challenges related to the application process is some requirements like legal fees, accounting fees, marketing efforts. It lowers the barriers to capital access, but there are some of these procedures involved, which can be costly to under-resourced women-led and minority entrepreneurs. Right, so I feel like there should be kind of minimized costs related to these requirements. Also, there could be some subsidies or grants that can help out women and minority-led founders to kind of to come up with the preparation costs.
And just one quick follow-up. I noticed in your report that, if I recall, crowdfunding peaked in 2021. That's the year following George Floyd's death. And now it seems like it's starting to dip back down. You think that we'll get back down to with the 2018 levels and not peak again?
It's hard to tell, to be honest. It was good to see some uptick in the number that it has been increasing, but I think in 2020, so after 2022, I think the rate has kind of, the participation of Black and Hispanic founders have went down a little bit, has slowed down. Yeah, it's hard to answer that question. And also in 2022, there has been also a lot of like macro environmental factors. There has been some challenging economic conditions, which could make them more difficult to participate in this funding program because there are some resources that cost involved in participating. So, I mean, it's hard to tell like what the rates will be in the future, but I feel like there needs to be some ongoing interest and efforts needed.
Bart?
Hey, Dr. Chang, thank you very much for your presentation. I just had a question. Do you have any data, demographics or amount of investment or otherwise on the investor side for Reg CF? I know the report focused on a lot of the issuer side, but I'm curious if there are any insights to be learned based on the investor side of things.
Yeah, it's hard to get information about who these investors are, and I've been always curious about these investors. I did spoke with some platform founders to get insights about what the profile of investors look like. It varies by platform, but based on my conversation with three platforms, around like 85 to 90% have been non-accredited investors. So it's opening up investment opportunities to kind of regular everyday investors, not just accredited investors. The gender and their all of them were not willing to share their race ethnicity information because they are not being collected. Also, gender information, it's like not required information to be collected to kind of sign up for the platform. So the exact numbers are hard to get, but roughly it was around like 70% 70% male and about 30% female.
Wonderful. And I just have one question. The one section of your report that piqued my interest was on offering structure. And just noticing that, though the report states that this is similar to the practice of VCs, we see here that, 32% of the equity-based securities or of the securities issued were either common or limited voting, non-voting common. And another 28% were safe, simple agreement for future equity. So about 60% of the total securities issued are really in formats which, VCs and I would say most savvy angel investors would almost never invest in. And a safe is one that we really desperately prefer not to invest in. Yet, people who go onto these platforms believe that they are investing on the same footing or in similar securities to VCs. And this, really does present a lot of risk through lack of structure. So what are your thoughts there on how that could be improved, or at least people could be better informed that the securities the VCs get and what they're getting are not the same?
Right. So I think there needs to be more education materials by platforms and policymakers about what the structure looks like, what does it mean to investors. So more kind of disclosure education, I think, is required to make sure that the people are making informed decisions. In terms of offering structures, like it is difficult to control how business owners, what type of business offering structure that they would prefer, they should select. Right? But I think it's good to have a lot of options available for different types of entrepreneurs. But definitely I think there needs to be more information training to these everyday non-accredited investors to make sure RegCF is a sustainable funding source. But if everyone else in this audience have a better solutions or insights, please let me know. I would also like to learn more about it.
Okay, great. Do we have any more questions from the committee? All right, wonderful. Dr. Chang, thank you so much for your time today. This was so informative, and I want to thank the committee for all of the incredibly insightful questions.
Thank you, everyone.
Apologies, I'm having a little bit of a technical issue with my computer now. I'm bringing up the document. Somehow it has been hidden, but it will come up shortly. And I believe our next step is that we can get into the discussion on RegCF, talk a little bit about what we've learned from this amazing presentation. And I think it would be a great idea for George to kick us off with some of his thoughts on the topic.
Yeah, happy to. I have been eating, sleeping, and breathing regulation crowdfunding since 2017. So happy to share some thoughts. And I think, Herb, you asked a really salient question about, is there something in particular holding entrepreneurs back from using regulation crowdfunding? And I can say with a lot of confidence that the number one thing that we see holding people back from using regulation crowdfunding is the requirement for reviewed and audited financials at $124,000 threshold. As you can imagine, a lot of these companies as Dr. Chang pointed out, many of them, the majority have less than 3 years of operating history. Most of them do have a good bookkeeping relationship. Most of them do have a CPA. But to get reviewed financials for a small business can cost anywhere from $5,000 to $10,000 per year. So for 2 years of historical financials, you're talking $10,000 to $20,000 to raise $125,000. That makes the cost of capital through regulation crowdfunding extremely high. And if you look at the data on regulation crowdfunding, you'll see a tremendous number of offerings that cap out magically at 124, and then they go home. We saw through the pandemic relief, the SEC temporarily raised that limit to $250,000. And we saw the number of businesses able to raise between 124 and 250 really surged. And at least from our limited view, we actually saw businesses that raised over, at the time was 107,000 was the threshold. We saw the businesses that raised over 107,000 actually have higher outcomes, better outcomes. And there's two reasons for that. One is more fully capitalized businesses that are artificially compressed on how capitalized they are by the 107 or 124K cap. Are less likely to be successful because they don't have as much money in the bank to go out and buy the equipment they need, open the new location, whatever it might be. And secondly, our data internally at Honeycomb is showing that the number of people participating in an offering is directly correlated to successful repayment of a loan. More than credit score, more than years in business, more than profitability, the number one correlated factor to successful repayment to date on Honeycomb, our very limited data set, has been the number of people participating in an offering. So it really goes to show that there is knowledge in the crowd, that people voting with their wallets on a product and a company they believe in is actually helping to de-risk that company. And I think there's some pretty compelling evidence that we should consider raising that reviewed financial cap back up to 250,000. I've also seen proposals at 500,000, which I think would be worth discussing as well.
Herbert?
Are we allowed to ask our colleagues questions?
Ask away. You're allowed to absolutely grill him.
George, I have a question for you. On the reviewed and audited financials piece, clearly that's a barrier. Are they allowed to accept that $5,000 to $10,000 costs for the reviews as a part of the investment?
Yes, but keep in mind you have to spend that money before you can host your offering. Mm-hmm. So you're making this $10,000 investment into your financials, but then you don't know if you're necessarily going to hit your funding goal. So you're kind of taking a gamble that you would be able to fund that. And keep in mind that one of the things that's disclosed, and rightfully so, is a detailed accounting of where you're going to spend your money. And investors tend to be less excited about paying your accountant than they do buying your equipment or helping you develop a new product or whatever it might be.
So I was asking for me personally, could I do that as a part of the investment? If I know a small business and their financials are strong, but they're lacking the resources to get, well, relatively strong, they're lacking the resources to pay for that review, could I pay for that review knowing that I am then also going to invest in that in them through that crowdfunding platform?
It would probably have to be a private transaction happening outside of the Reg CF framework.
And my second question, something you said most are successful because of repayment of a loan. Is that a repayment of a loan on the platform or to a CDFI or bank or something?
To the platform. So Honeycomb operates, we're primarily a debt and revenue share platform. So 95% of our offerings have monthly recurring payments. Mm-hmm. So that's the framework that I.
And I'm sorry, one quick follow-up to that. If I, as a business owner, comes onto the platform to get a loan, do I still have to have the reviewed financials?
Yes.
Okay. Yeah. Right. Thank you.
While we're grilling you, George, I have curiosity. Do you have any information or any insights you can see on the investor side in terms of, are you seeing them capped out on the amount that they can invest? I think you've made comments before about that you have seen some patterns in the investments that they kind of invest in one and then will invest in others from there. But are you seeing any limitations on the investor side based on the total amounts they can invest, or anything on the caps on that side?
Yeah, good question. Historically, we saw a lot of issues, but the changes in 2020, there was pretty sweeping changes. The two biggest ones, as far as I'm concerned, one, the increase from 1.07 million cap on how much you could raise to 5 million really helped. And the other was, historically, they were looking at the lesser of your income or net worth. And we ran into a tremendous number of issues where young people coming out of medical school, very high income, very low net worth, were capped out. And vice versa. Retirees, relatively low income, relatively high net worth, were capped out. They've changed that to the greater of your income or net worth. And since that change, we've seen very few limitations.
Sorry. Oh, sorry.
Oh, go ahead.
Sorry to keep you on the spot, George. So I'm a little bit curious. Andrew Schwartz in his book indicates that platforms actually play a role in sort of screening the companies that they allow to come on and do a crowdfund on their platform. And I wonder, I don't mean to keep putting you on the spot, but can you speak to that a little bit, maybe about what your process is, or if you want to speak more broadly, that would be fine as well. Thanks.
Yeah, I think every platform has a little bit different philosophy on this. Some platforms take more of a all comers are welcome. If you can meet the SEC requirements, then you're welcome to use their platforms. We do have certain criteria at Honeycomb. Some of those are financial criteria. We're looking at debt service coverage ratios. We're actually looking at credit on business owners because it is most of the time a traditional debt product. So we're following a process that's a little bit more akin to a CDFI or a community bank, trying to make sure that there's some level of confidence that we have as a portal that an issuer can service the debt they're about to take on. There is also many portals, including ours, will look at some level of the ability for an offering to be successful. So one thing we look at is we have some metrics we look at around social media engagement. Is there activity that around the business that demonstrates that if they post on social media, people are going to respond positively? Both because we want them to be successful, but that's also, we want to bring businesses that people are going to be excited about onto the platform.
So we've commented about the cost of the reviewed and or audited, probably reviewed at this level, and that's for just $124K being raised. But what are the other costs? What are the all-in costs? If you're paying for a review, there have to be other associated costs. So what is the all-in percentage cost of raising $124,000?
It varies widely by the platform. Obviously all platforms will have some cost to host an offering. That will range based on their revenue model. Usually somewhere between 7 to 10% of what's raised across the platform. Some of that's paid by investors, some of that's paid by issuers. Some platforms have a required marketing budget that they will say, hey, you're only allowed onto our platform if you certify you're going to spend so much money marketing your offering. We don't have any requirements like that, but we do see that at other platforms, and that will be another significant percentage of what you're raising.
So if I'm hearing that correctly, you're paying 7 to 10% to the platform, you're maybe having some advertising costs, and you're paying $5,000 or $10,000, which of $124,000 is another 7-ish to 10%. It could be easily 20% of what you're raising just goes into raising the money. That's like credit card debt. That's a lot.
Well, it is, yeah, and it's important to understand the alternative though for most Main Street small businesses. Bank lending through SBA 7A loans from the peak in 2007 is down almost half. the average size of an SBA loan went from about $140,000 to $550,000. So as we think about traditional Main Street small businesses, the ability to access capital through traditional providers is essentially gone, and the online lenders that have replaced them are extraordinarily expensive.
Davion?
George, I'm going to keep you on the spot because you're doing such an amazing job. Thank you for the insight. Just a couple quick questions. I know for the most part, a lot of these businesses are small businesses versus high-tech startup companies. I'm curious what percentage, if any, you're seeing on the high-tech coming into the platform. Additionally, I'm curious to understand if companies that are going to raise follow-on capital, if that is perceived as a negative impact in regards to going down the path of utilizing some of these different platforms.
Yeah, it's a good question. So on the first part, with Honeycomb, we do some high tech, not a lot. It's less than 5% of what we do. To Erica's earlier question about how we think about the asset class within equity, we require that they have a term sheet from an outside investor, and we just follow that term sheet exactly. So we try to make sure that they're investing at the same exact terms as other outside investors. But again, that's a pretty small percentage of what we do. And it typically is, I think about it as kind of a donut hole between standard high-tech, high-growth, venture-backable companies and kind of Main Street companies. There's businesses in between that are sort of tech-enabled, might not have venture-like returns, but also might have a longer growth timeline to get to profitability and therefore be able to take on traditional debt. And so that donut hole, we're seeing a lot of companies come to RegCF, and it's a good fit for them. In terms of does RegCF prohibit you from raising in the future, one issue in the past was it was very, very difficult to use SPVs to invest on regulation crowdfunding. As you can imagine, most people don't want 400 people on their cap table. Again, in the 2020 changes, they made it easier to structure an SPV to handle an equity offering, which in turn does, at least from a cap table perspective, make things much more manageable.
That's kind of where my question was going.
Diego?
Yeah, so I'm gonna keep it going. Question around sort of the success rate. I guess you can speak on Honeycomb, but also industry-wide. If you can share a bit about the success rate of percentage-wise of people that or businesses that go into the platform versus the ones that actually get funded, and then also if you can share a bit about how many are unsuccessful to the point that they default on their loan, or what does that look like? What does that look like percentage-wise and process-wise? And then the third piece, curious if you can share a bit about a lot of the discussion today has been around underrepresented founders and underrepresented minorities, and so I presume that equity crowdfunding is opening up funding opportunities for underrepresented founders. So wondering, what trends are you seeing there when you look at the requirements of social media presence and other type of requirements? Does that present a barrier to these founders, or is it actually less cumbersome than traditional funding mechanisms?
Yeah, good question. So in terms of success rate overall, we're seeing across the industry kind of 70 to 80% of people that post a RegCF offering are getting successfully funded. So quite high. Honeycomb is in that similar range as well. In terms of the successful repayment rate, we've been historically at about 96% successful repayment. That is roughly a charge-off rate that's 3 times lower than comparable SBA loans. So government-backed, taxpayer-backed loans, our charge-off rate is substantially lower than them. kind of in the same sub 250K range. Around the access to capital for diverse founders, last year in our impact report, we were really proud to show 85% of the businesses we worked with were minority-owned, women-owned, and/or based in low to moderate income communities. If you expand that to include veteran-owned and LGBTQ plus owned, that's over 90% of the businesses that we worked with last year. That I can't speak to that data across. Dr. Chang would be better to speak to that data across regulation crowdfunding, but we definitely see that founders from diverse backgrounds have a harder time getting access to traditional capital. I don't think it's a secret to anyone here in the room, and they get really excited about regulation crowdfunding as an alternative.
Just as a quick follow-up, so would you, and I presume the answer is yes, but would a productive recommendation from the committee be this sort of permanent raise of the limit, the cap on when founders need to provide accredited or audited financials?
I think it would be a tremendous benefit, especially for younger, smaller businesses, which are disproportionately from founders of diverse backgrounds. And it becomes this really important stepping stone to get them to an SBA loan, to other traditional funding sources. But that, bank lending doesn't really start until about 250K. So there's a missing rung on the ladder, and Reg CF can be a piece to help fill that in.
Great.
Marcia?
I'm going to take you off the hot seat, George. I have more of a question, I guess, for Stacy and the SEC team. So I'm curious. I'm trying to wrap my head around like the $124,000 number of the limits. First of all, it's curious that it's $124,000 in income for those limits, and then it's also $124,000 for the amount of money that you can raise. So that must have been a really popular number. I hope somebody played the lottery on it. And then when the like during COVID, when it was raised to 250, and to George's point that you said that there were a lot of people that really utilized that and they were able to be successful, but then it went back down. So I'm guessing that the $124,000 mark was so that that would be protecting investors, because you'd want them to see the financials if they were raising a lot more money. But considering that most of the investors are only going to put in a couple $100, maybe $1,000 at the most on average, then kind of what is the thought process behind like actually raising that? Because it seems like to me, we should raise that limit, but I don't know that I understand enough of the background to be able to say that that's a good idea or not.
I don't know that I know the exact answer to your question. I mean, I can say that there are requirements that crowdfunding be inflation adjusted every 5 years. I'm looking at Julie also to make sure I'm saying that right. Yes. So, I mean, I think to your point, Marcia, and I honestly don't know, but I think that could be part of why you see the similar numbers. Yeah, it was all 100. Yes, it was 100. So with the inflation adjustments, it played out.
And so was that limit though put in place for the amount of money that could be raised as a strict investor protection for, with them not being able to see an audited financial or at least a reviewed financial?
Is your question about the overall limit, or is your question about the limit for the financials? At which point the financial statements go from being not required for an audit to?
Yeah.
So it was raised during COVID to 250.
Right.
And then it was extended for a temporary period of time, and then that extension was lapsed. It just wasn't extended again.
And is there any information or data around that time period when it was at 250? Were there problems for it being at 250? Was there pushback from investors at all that they wanted to see more financial information?
I don't know.
Okay, just curious.
Okay, so, I think these are really good questions. Just in the interest of time, as we have a little bit less than 20 minutes until lunch, I would just like to recommend that going forward, we maybe go around or raise hands. I'm not going to force everyone to come up with an idea, but why don't we try and narrow down a few of the items where we think we could make positive change, whether it's on investor protection or on reducing the regulatory burden for issuers. Yes, Bart.
Just sort of piggybacking on that, but I wanted to, since Commissioner Peirce sort of called this one out specifically, she asked questions about the curation, the limitations on that. George, to, I guess, pick on you real quick. Is that a limitation? Is that something that, when we're going around talking about recommendations, that should also be mentioned?
Yeah, for a little context, as a registered funding portal, we can't give investment advice for understandable reasons. We're not registered investment advisors. We're not broker dealers, or most of us are not broker dealers. So there's limitations on what type of recommendations we can make on the platform, and there's logic to it, but there's also some restrictions.
And is that an area that we might want to explore for a recommendation? The funding portal's ability to provide sort of basic curation and guidance on deals?
I believe so, especially as we see the number of offerings growing very rapidly, particularly within the top 5 portals. It can be really overwhelming to land on a site and see 100 different offerings and have to. The more a portal could kind of direct people to the things they're interested in, the more likely we are to get capital flowing to businesses.
And do you get sort of a standard set of or common questions that might guide, what would be an example of impersonal advice that you think people are looking for from your platform?
It can be things as simple as we know that if someone invests in a small business in Cleveland, they might be looking for other investment opportunities in Cleveland. We're not allowed to just put Cleveland opportunities in front of them. We have a tremendous number of our investor base will reach out to us and say, hey, we're really interested in investing in green businesses, show us more of those. Or we're really interested in investing in black-owned businesses, show us more of those. And there's limitations on how we can curate that.
Can I ask a question, follow-on question to that, George? Would you be able to put in filters such that the investor that went in there, they could search on Cleveland, they could search on green, and just those companies would come up?
Absolutely. And that's okay. For investors to pool that information is very easy. In order for us, though, as a platform to push that information, that's where the limitations apply.
But you can push the fact that the filters are there, right?
Certainly, yep.
Okay. And George, from your perspective, what are it would seem that you would be taking on some of the liabilities involved in being an investment advisor. What are the biggest concerns that you would have if you were able to give, educational and direction to folks in regards to the path that they could take?
Yeah, we don't, I'm speaking for Honeycomb, we don't intend to become an investment advisor, just more giving people the ability to choose the things they want to see. At any given time, we can have upwards of 100 businesses offerings on our platform, so it can be difficult for people to sort that out. The filters are a starting point, but being able to...
Yeah, I was taking it from a totally different direction. Yeah. I was taking it more from the direction of, the education question that came up and how do we advise individuals that are actually trying to benefit from the platform to actually raise capital. And so you wouldn't ever want to go down a path of actually advising those individuals. And that's the angle that I'm, wanting to ensure that there aren't any liabilities or concerns that you would have as a platform.
So as a platform, we're required to have quite comprehensive educational materials. Every portal is, which we do, of course, and then we try to go above and beyond that. But I don't know that we want to go, exactly, yeah.
Sue?
Okay.
Sue?
Yeah, I've got one last question. I think at our last meeting, I remember a comment you made that I thought I had it on, sorry. while you made a comment at the last meeting that while crowdfunding was increasing and the numbers were increasing, at the last meeting you mentioned that it's still a very small percentage of people that were eligible to become a crowdfunding, a CF investor, were actually participating. Can you speak at all about how we might be able to have better participation, better awareness amongst people that they can go fund their local small business this way?
Yeah, I think one of the biggest limitations we see there is that, understandably, the way an issuer can talk about their offering is very, very limited, to the point that they're not allowed to say if it's debt or equity or revenue share. And the indirect advertising has been a real complication. As you can imagine, there's a lot of really fun, feel-good stories through local media that come out of these offerings. If a reporter decides to put the terms of those deals into an article and a business owner simply puts that on their Instagram feed, we have received warnings from FINRA that they must take those down. So even if another source, a reputable source, pulls information from outside of the funding portal and puts it out into the world, the business owner can't even associate with that from an arm's length. And that hurts the ability to educate potential investors and get people excited about the opportunity.
So if I may, it's just tying some of these thoughts together, because one of the topics and questions I think that we were emailing about before this meeting were some of the other recommendations and ideas that have been explored in the past. And one of them was the idea of, should pooled vehicles be able to raise capital on Reg CF platforms? And I think it's interesting as we're having this discussion, right? Because the internet platforms, right, do not want to take on a fiduciary duty, but you think about the risk associated with making an investment or loan to a single issuer. And so one of the things I wonder about is perhaps an elegant solution is being able to offer investment in pooled vehicles that are well diversified on the platform, so that way you're diversifying away any risk of loss. And then these entities, the pooled vehicles that have other regulations, could be in a position to market those pooled vehicles. So thinking about ways that we might be able to grow the pie, provide more access, provide more security, less downside risk, and open up more opportunity for more businesses that perhaps might not exactly meet some of the screening criteria of different platforms, but when in a diversified basket, conditions are set differently. So I'd be curious to know any thoughts that folks on the committee might have about that. Also, just from the SEC team, just any background on discussions that you might have around pooled vehicles on Reg CF platforms.
I'll just say that generally, and this is just speaking anecdotally, what we've heard is that what was done in 2020 in the harmonization release to allow pooled, the SPVs, has not been felt to be working as well as some might have hoped.
That's good to know. When I think of an SPV, I think of, you can only have a single company in it versus multiple. But that is really interesting, because I would have thought that would have had more uptake in terms of equity offerings on the SPV side.
And Bailey, you're thinking more mutual fund type approach, right? Where there's
but private funds, limited partnerships, more like a traditional, seed stage type fund, but investing earlier, where it might make investments in or provide, revenue-based loans to, say, 20, 30, 40 different companies. I mean, depending on the size of that vehicle and the number of bets that it's taking.
No? Okay. Oh, Herb?
Just a quick question for our colleagues from the SEC. The testing the waters permitted before Form C is filed, with that, you still have to do the audited reviews? No, you don't?
No, that's simply an opportunity to, before you filed your Form C and made the decision to do a crowdfund, to go out and sort of test to see, is it going to be viable? Is it worth your time to do that? But if they proceed forward with
Then you have to do the audit. Okay,
right, yes, depending on the amount you're raising. If they then proceed forward and do the actual crowdfund, then yes.
Okay, and Madam Chair, one for consideration is possibly doing something similar to what the SSBCI did with the technical assistance. If we could look at providing some technical assistance for these businesses to cover that cost for those reviewed financials, that may be an area that could be helpful to small business owners.
Okay, great. Can you elaborate on that a little bit?
Yeah, with the SSBCI, they've got a bucket of money that they commit to CDFIs and VCs to invest in small businesses, but they also have a bucket of money that they've committed to community development organizations to help them with technical assistance, to pay for some legal services, pay for financials, financial literacy, and to pay for some marketing. And each state determines how much they're actually going to commit, and these are grant dollars. So they will certify vendors within their areas, and then if I, as a small business, go to them and says, hey, I want to get my business right so that I could apply for VC or angel investing, they could reach out to that financial partner and tell them, hey, review Herb's financials, make sure they're ready to be presented to an investment agency, and those are grant dollars that are provided to that small business owners. And in this instance, if we know that those reviewed financials are $5,000, we're talking grants with vetted organizations within a community where the community development organization would pay for those reviewed financials so they could then apply for resources from the crowdfunding platform.
Thank you. All right, wonderful. And just one more question that I wanted to cover. I think that we're possibly all interested in evaluating the sensibility of the levels set currently for financial statement requirements versus the costs. But what are the ongoing financial reporting requirements for people who have raised money with Reg CF?
So they have to, on an annual basis, as I walk through, they have to file an annual report 120 days after their year end. And those do require financial statements. And one of you, correct me if I'm wrong, I believe in the annual reports, and maybe George, they are just certified by a chief executive officer. I don't, unless they have audited financial statements, and then they provide those. But I apologize for not having the rule completely memorized. So they do. So they do still have to provide the financial statements in the annual report, but with a lesser requirement than in that initial offering.
Okay, and is this something that they're required to provide to their investors or to the SEC?
The annual report's filed with the SEC, and then it becomes accessible to the investors, and I believe they have to post the annual report on their website.
All right, wonderful. Great. So we only have a few more minutes before lunch. It might be a good opportunity to kind of go around the room and see if anything that might form the basis of a recommendation is jumping out at people. So why don't we start with Sue and we'll go around.
Yeah, I think as you alluded to, Erica, I would be very much in favor of raising the limit. I mean, just raising $124,000, having to have all those costs, it doesn't seem like a good cost of capital decision. And I think a lot of companies aren't doing it because that cost of capital is so high. So I would be very much in favor of raising that. I also really liked Herb's idea about rolling this into vehicles that are already out there. So even if we raise the cap and they have to have a review, they could apply for a grant through these vehicles to cover the cost of that review. So I think those two things are really important. And I don't know how to solve it, but this idea of not being able to let anybody know, so that more people could participate in the raise, That's probably something that warrants more discussion, but that certainly seems like there should be some way to course correct that. But I think those two things, raising the limit and allowing the SSB, BCI, IBC, I can't get those initials right, allowing them to provide grants. I think those two things together would be very helpful.
I think those are great points, Sue. I was thinking about the grant idea also in regards to how we can help people prepare. There's a couple programs back in Kansas City that mostly for technology companies, but they're grants, non-dilutive grants that help people to prepare for larger fundraising. So I really like that idea. A couple things that I believe we should explore is really the structure of the deal and the terms associated with it. I don't know how deep we can go. The marketing side of it is, I have mixed emotions. I've seen people be able to leverage the marketing to be able to get more people to participate, but I've also seen exceptional marketers also be able to raise and not necessarily execute on the other side. So there's a little bit of a balancing act there in regards to how do you protect the investors, and there's some execution associated with the marketing. But I echo what Sue says with those two additional points.
I'll echo my co-executive members, and I would also add, I'd be interested to know more about what information investors are looking for and how we could provide that without running afoul of investment advice regulations.
I agree with the recommendations.
I don't think anyone's surprised. I would agree with increasing the limitations around review and audit financials, at least to $250K for reviewed financials. And I do think evaluating the ability for indirect advertising and kind of advertising by accident whenever terms work their way into third-party materials would help get Reg CF out to more potential investors.
Yeah, I'd agree with the recommendations. We have an awareness problem, I think, with all of this about getting funding to early stage companies, and we'll probably talk about it a lot more this afternoon when we talk about angel investing. But I definitely hear your point on the marketing, and where do we draw that line? So I don't know, maybe there's something that we could do, or that the SEC could have. I mean, the SEC has so many amazing resources. Maybe we need to educate people that this is an asset class, not necessarily market the individual deals so much, but actually let people see that this is a possibility for them. To Commissioner Peirce's remarks earlier, that we do have a perception in our country that you have to be wealthy and you have to be well connected in order to invest in an early stage or in a private company. So I'd be interested to take that a little bit farther.
Madam Chair, I endorse my colleagues' recommendations.
I'll echo everybody else. Just to mention something else, is sort of a technical matter that I would sort of say the SEC when they are looking at this. The other thing within Reg CF that has always given me a little bit of background worry when I'm talking with clients is the 13G requirements of having more than, which basically says if you have more than 500 non-accredited investors, it could force you to start acting like a public company. There are carve-outs for Reg CF, but I think those expire after some income threshold or a few footfalls. So I would just say, without a recommendation, sort of mention that that's probably something else to look at, because as Reg CF takes off and you get more and more, right now I don't think it's much of an issue that people are coming close to that 500 person threshold, but I could definitely see that being an issue if this gets popular.
Yeah, nothing substantial to add. I think I agree with everything that everybody said. I think the only thing that I would also question is around that publicity, marketing, sort of wanting more information around that, because you provided, I think, great insight, George, but I'm still not clear as to how that affects founders specifically. So just understanding that a little bit more would be helpful as we continue to discuss.
Yeah, I think what everyone's saying, it makes sense. I'd be interested to learn a little bit more about what happened when the thresholds were raised, what the outcomes were, whether that led to more investor confidence, more downside, or what the risk was and what the outcomes were. I don't think we received any data with how the raising of the threshold impacted the companies that were operating. The other thing I would like to see more data on is the success rates of the amounts that are raised, right? So if do we have, and I think George might have mentioned this, but it would be interesting to see if we're raising these thresholds, if there's a corollary with how the outcomes and how successful the company is. I do agree that if a company's undercapitalized, that opens it to other risks, but we also want to be careful not to increase or create this motivation to increase now that, to 250,000, a company might not need it. So now we're overcapitalized, we're raising too much money. So I think these are important things to weigh, and just in considering where that balance lies.
I agree with everyone else. I also went to George's website, which this is an area that I'm not familiar with, and I found it sort of interesting to look at what he has here. Thank you very much, George. Thank you.
One of the most amazing things that came out of Dr. Chang's research was looking at the crowdfunding and the companies that are issuing on it, which was very excellent research on that. What it also showed is that there's not as well as an understanding of who the investors are. In FINRA, the FINRA Foundation, through COVID, we started looking at the investors. We do a national financial capability study every 3 years. And during COVID, we looked at new investors in COVID. And our most recent study was in January, investors of color, and looking at how they're investing. The good news from this investor research is we're seeing younger investors getting more involved in the markets, and they're making more diversified choices. They're investing in crypto, they're willing to take chances. The problem is that there's not a lot of data on the investors in the crowdfunding, and maybe this is a way to take a look at who they are, what they're willing to invest in, and if the younger investors are willing to invest in crypto and take more risk, should they be available and taking a look at what's happening in crowdfunding?
That's an excellent point. And just building on that, I think it would be interesting to do more analysis broadly to understand alignment across the stakeholders, from those that are seeking to issue, from the platforms to the investors, to see where there is alignment, what are the commonalities and the factors, and when those companies are successful. And so trying to do a more in-depth correlation analysis. Is it that we're finding that companies that are X years old or in certain industries, and maybe they're doing an equity issue, that those are more appealing to X set of investors who have more money and therefore they're more successful? So who is it working for? Where are things well aligned with how things are set up today? And where are their stall points? So who is it not working for? Because I think one of the really elegant things about Reg CF is that it was designed to be a capability that could potentially solve for lots of different problems for accessing capital. But what we don't know is where is it working well, and what are all the other stall points at a more granular level. We're just talking more about thematics, about the people, but not the overall mechanics and alignment of incentives across the system. So I do think that there's a great opportunity here for more in-depth research and analysis that could inform policy and regulatory decisions.
I think I would add on to both of those as well. I think having more data, and I'm also interested in understanding how the intermediaries are assessing as they go through the process about what companies and what issuers they're allowing to do a crowdfund on their site. And I think it would be interesting to have more data sort of about that process to lend insight. And I think building on this of like, are people being vetted out, and why or how are they being vetted out of that process?
Bailey, I've been thinking about your idea around just to streamline it. I'm going to call it a portfolio, to diversify risk. And it would be interesting to understand if people are not participating at the levels that they should participate because of the risk of not success, right? Or not getting their money back, or not seeing some return. Because if they are, then potentially the diversifying of this, I called it a mutual fund in our worlds, right? But this portfolio can help to diversify the risk. So I don't know if that's something that we can, explore, but I think it would have to be driven by if the reason people aren't participating is because of their fear of, success or the return on the investment. So I was thinking through that and thought I'd throw it out.
Yeah, and I think on that it's very important, to think about why we have diversification as part of portfolio theory. That's because there's a tremendous amount of data around public market stock returns that has proven that diversification works for public market stock portfolios and some other asset classes. We can't just sort of wholesale without returns data assume that it's going to work for crowdfunding deals. So I think that's really important to point out, that we don't conflate the two without having the data. And on that note, I do think it's really important that somebody somehow can actually find some real returns data on crowdfunding deals. It seems like we have a lot of information, but no information around what actual returns to investors have been. And so I think that information would not only be really important to investors going forward, right, to have some, historical looking numbers, but also how, we make recommendations in the future. So wonderful. Any last minute thoughts, or shall we break for lunch and resume at 1:15? Okay, wonderful. Great job this morning. The committee will be breaking for lunch. Thank you to everybody who's with us on Zoom or WebEx, probably WebEx. And we look forward to seeing you again at 1:15.